Welcome to this week's edition of Flashback Friday, your opportunity to get some good review by listening to episodes from the past that Jason has handpicked to help you today in the present and propel you into the future. Enjoy.
This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Hey everybody, good day and welcome to the Creating Wealth Show. This is Jason Hartman, your host, and thank you so much for joining me today. Our guest today will be Jeff Reeves. He's editor at investorplace.com and author of the Frugal Investor's Guide to Finding Great Stocks. Now, you know me, I'm not exactly any fan of stocks. I have these Wall Street guys on because, they offer a lot of insight on the economy and the markets in general. And so we definitely would be remiss if we didn't have them on the show. Even though you know me and what I say about Wall Street, right? It's the modern version of organized crime. Jeff will be with us here in a few minutes to talk about that. But first, I've got Sarah back on the show. And Sarah, welcome. How are you?
Hey, great. Thanks for having me. Thanks
for helping me with the intro. And let's hope that in this intro today, we don't shoot ourselves in the shoe.
Oh, boy. Okay, so... I'm never going to live that one down, huh?
You're not. Folks, in case you're not, if you're silly enough, people, to not be a regular listener to this show, you are really missing out, obviously. Okay, but if you're not, I'll give you a little background. So Sarah is one of our investment counselors. She does this funny thing. She takes old sayings, that have like cliche sayings like, don't shoot yourself in the foot. And then she does like funny things to them unintentionally. And it's just kind of funny, to tease her about it because she was on a show a while back and she said, well, I just hope our investors don't shoot themselves in the shoe. And I said, Sarah, it's shoot themselves in the foot. Okay. So.
Well, wait, it's kind of like the new paleo diet I'm going to try, right?
Oh God. And by the way, folks, that's the paleo diet.
So is this a 10th show? Can we talk about the paleo diet?
No. Well, we can talk about the paleo diet just for a quick moment anyway. I know a few of our listeners are going to hate this. That includes you, Christina, who's probably listening and going to write something on my Facebook after listening to this. But I mentioned to Sarah before we started recording that I just ate lunch, and listeners, I don't make a nickel, a penny, a dime out of this. I make no money off this. But I want to give you a really cool recommendation. We all have a few things in common. Remember, I always talk about the 3 human needs, and we as investors provide one of them. And so what are those 3 needs? Food, clothing, and shelter. We're going to address all of them in this show because the first thing we talked about is not shooting yourself in the shoe. That's clothing. Okay. And now we're going to talk about food for a second, and then we're going to talk about housing. Okay. Shelter that hopefully those people will rent from you. And I've been bugging Sarah and a few of my other friends and associates about this thing I started in January, and I cannot believe how incredible it is. For any of you who know me, you obviously, I'm sure, would agree that I do not need to lose weight. I need to gain weight. But I will tell you something. I had this executive health screening right after Christmas, right before New Year's, and I talked about that on the show a little bit. And they recommended the paleo diet, which is basically the diet that, if we were living in caves, that's how we would be eating. We would be eating, we would eat meat and we would eat vegetables and fruit and things that grow. We would not eat bread or carbohydrates or any of these man-made things like grains and that kind of stuff. So in January, I went on a very lightweight, not very strict version of this. I still have a sweet tooth. I still like cereal. I cheat all the time. But I couldn't believe it with just a moderate amount of working out, how suddenly I had a six-pack abs. I mean, they're not incredible. I'm not getting a job as an underwear model for Calvin Klein anytime soon, but it was surprising how easily the body fat just fell right off. I without even trying. So I've been bugging Sarah. I said, look, you have 2 kids. You're busy being an investment counselor. Make your life easier and just go online to personaltrainerfood.com. I make zero money off this. They're not a sponsor or anything. And order personal trainer food. And here's how it works. I love this. Being a bachelor, this is like the answer to food for me. It's great. And what they do is they send you a big giant box with dry ice, and you've got all your gluten-free paleo foods in there for 28 days, breakfast, lunch, and dinner. And it's dirt cheap, okay? It's only like $4 a meal. And the food is incredibly tasty, and it takes 4 minutes to prepare in the microwave. Heating times may vary, and I just love it. It's like I'm eating really healthy, according to the paleo diet, assuming you agree that that's healthy. So that's up for debate, but I think it's pretty good. I'm just eating the super healthy food, and it's super convenient, and it's, really one of the important things to do is eat regularly. And Sarah, I know when we were in an office together, you were guilty of not eating regularly because you'd be busy calling clients and stuff like that. And I said, don't do that because it really messes up your blood sugar. You got to eat regular meals.
Yes.
And so this allows me to do. I love the personal trainer food. You can also order it on Amazon.com. You can't customize your meals as much, but even my massage therapist ordered it, and she loves it. I mean, everybody I know, I'm telling about this, so I just thought I'd tell you listeners. And personal trainer food people, I hope you'll become a sponsor of the show and pay me a bunch of money because I just really sent you a big fat gift right there.
Well, we'll have to forward them the podcast.
Yeah, that's right. We really should. It's really good. So how did we get on that subject of the food? Yeah, anyway.
You were just making fun of me, that's all.
Oh, yeah. I was making fun of you, and I just ate lunch, and I had great veggies. By the way, one thing that's interesting, I read a book, about 2 months ago. I can't even remember the title of the book, and it was, one of these famous doctor people who talks about nutrition and stuff. Anyway, one of the things he said that was odd is he said that fresh vegetables are actually not as healthy as frozen vegetables. And he did qualify that remark by saying, look, if you're growing fresh vegetables in your backyard, those are supremely great. If you're buying them at the supermarket, not so great. If you're buying them at a farmer's market, those are great. But if you're buying at the supermarket, because of the time it takes you to get there and the way they have to pick the vegetables for them to be ripe at the market when the consumers buy them, it's actually better to eat frozen vegetables, he said, because they flash freeze them much sooner after picking them, and it preserves a lot of the nutrients. So
yeah, that makes sense.
Yeah.
That makes sense.
Interesting. Kind of counterintuitive, really.
Welcome to this week's edition of Flashback Friday, your opportunity to get some good review by listening to episodes from the past that Jason has handpicked to help you today in the present and propel you into the future. Enjoy.
Well, healthy eating is definitely important for the real estate investor. We want all of our clients to be happy and healthy. And I really think that eating healthy changes your mood and puts you in the right mindset. And we want all of our clients to be in the right mindset for real estate investing.
It does. So this is the segue. We're not really going to make this a food show then?
That was the segue. Okay. I'm moving you along.
All right. I do need to be moved along all the time. So our guests, we'll get to that in a moment. But first, I wanted to ask Sarah about some tips for successfully investing and working with your property manager and all that kind of stuff. So Sarah, take it away.
The one concern I always get, and the one piece of this equation that is so important, is having a good property manager, and not just having a good property manager, but managing your property manager. And we've talked about that before, but I just wanted to give a few tips to our listeners. One would be on the repair side. Just be sure to get a few quotes on your repairs. Anytime you've got a maintenance item that comes up, if it's not an emergency situation, you really should get 2 to 3 quotes. Not only does that help you save on expenses, but it really shows your manager that you're paying attention and that you're not just going to let them, take advantage of you.
Right.
Another tip that kind of goes along with that is when you're signing your property management agreements, you always allow the property managers to have up to $1 amount where they can use their discretion on repairs. And most of them like to put in $250 to $400.
Yeah. And that's too high.
It's too high.
Yeah, it is. It is. You should make that $100. And I would make it, remember there's two things here, investors. There's per incident or item, and there's per month. And I would make it per month, okay? So I would limit that to $100 per month, not per incident, because in 1 month you could have 2 incidents or 3 incidents, right? Let me just kind of qualify what Sarah is saying. It's great advice that she's giving you. When you're in real estate, the way we do it, you are a direct investor. So you are really in control of your investment. And unlike traded assets like Wall Street type assets or partnership deals or investing in someone else's deal where you don't have control, there's lots of padding, I'll say, in expenses in all those kind of things where they're skimming a lot of that profit away from you as the investor. And here, even if you have a property manager who really overcharges you, like say you get a bad apple that's just a bad property manager, and occasionally we run into those. It's not common, but it happens occasionally. The damage they can do is much lower than the kind of damage some executive at a company in which you invest or, the financial services cartel or any of these entities and people out there. Anybody running some big LLC that you invested in can skim all sorts of profits off the top and all sorts of benefits off the top. And there are so many ways in which they can do this and so many ways they can hide it from you. So this is minor stuff. Okay, so I first want to qualify it that way. But just because it's minor doesn't mean you shouldn't be a careful, prudent, attentive investor. And that's what Sarah's talking about. So on her first point, when she talked about the repairs and getting multiple estimates, look at, Sarah, I'm sure you'll agree, if this is a $50 item, you don't have to get 3 quotes. Okay, it's a $50 item. It's pretty simple. And the other thing you can do is you can just check online to see what parts cost. And a lot of this stuff is really quantifiable. So if a property needs, for example, a new garbage disposal, you can go to homedepot.com or lowes.com and price a garbage disposal and then just extrapolate a reasonable amount of labor. Is it 1 hour of labor? What does an hour cost? Is it $40 an hour to pay that contractor to put that in? So there you go. $150 for the garbage disposal, $40 for labor, it's $190, okay? Just an example, you can get a cheaper garbage disposal. I'm just giving you an example. If it's an expensive item, you need 2 quotes. If it's a really expensive item, you need 3 quotes. I want you to get the quotes on the actual quote document, and I would say paper or estimate sheet, but a lot of it is by computer nowadays, obviously, from the actual contractor who's going to do the work, not on the property manager's letterhead that says ABC Property Management, this is the quote. They're not the one doing the work. They're contracting, they're subbing that out to someone who's doing the work. And to keep the possibility of any graft and corruption down, you need to see it right on their document. So it should say ABC Plumbing or ABC Garbage Disposal or ABC Handyman. That's who the quote comes from, not the property manager. It may come through the property manager, but the quote has ABC Plumbing on it, for example. And it should have their phone number and their address and maybe the domain name for their website, or you can just in 1 second Google them, see what their Yelp ratings are and their reviews, see that they're a legit company. You can shoot them an email and ask them a question or call them up, all these types of things. This stuff takes like no time. It's really easy to do. Sarah, thoughts?
I agree. I mean, I remember years ago, I did the same thing and I got a few quotes, and literally about an hour of my time making phone calls to contractors and exchanging emails and so forth saved me like $1,300. So, just pay attention, use a little bit of common sense, and don't just always go along with what your property manager is advising you to do. Usually they give good advice, but sometimes you find ways to save money. So just do a little research.
And one of the points you made, Sarah, that I think is so important, what you're doing when you do this kind of thing is you're letting your property manager know that you are paying attention. And once they see that, oh, this is not a pushover, it's not an investor who's just going to, go with the system. This is someone who's attentive and they're prudent and they want the best deal. Once you kind of set that standard, then usually for years and years of the relationship, I mean, some of my property managers, I've had them for 10 years, okay? Once you set that standard, then they kind of know, and you sort of put them on notice, and they're much more likely to take good care of you throughout the years.
Either that or they get sick of hearing from you and they just do their best to get you a good deal so they don't have to deal with you again.
Right. One or the other, either will work. Any other tips on that?
No, that was it. And then, just check your statements. I mean, it goes along with it, but, just review your statements, make sure you're not getting any surprise charges or, you're not missing rent. It's real easy to just, especially when you're getting a direct deposit. I'm guilty of this, not checking my statements, but you'd be surprised at issues that, might come up. And I'm like, well, didn't you catch this right away? And they said, oh, well, I don't look at my statements.
Yeah, you've got to look at your statements. Folks, this is just like your bank statement. You've got to look at that. You've got to look at your credit card statement to make sure there, aren't any fraudulent charges on there. And this is the same thing. And all this stuff, it becomes very easy if you just get into a habit of it and a system for it. And, highly recommend that you use the software we recommend to make all of this stuff much, much easier for you. So that's a great thing too. Well, that's good. Sarah, any other thoughts before we go to our guest?
Just wanted to mention, a few of our top markets right now.
Oh, yeah.
Yeah. We're really excited about the Little Rock tour coming up right around the corner. So we're going to have some great properties for that tour. And then, of course, Memphis is great for a cash flow market. And if you're interested in seeing any performance on these properties, you can just email us through the website. I also just wanted to mention real quickly, we do have some existing homes, meaning not brand new construction, properties in Houston and Dallas right now. There aren't a lot. So if you're interested in that market, we've got some real nice looking properties that pencil out real nicely on paper as well.
Yeah, and I recently toured the Dallas properties there, and they're mostly in pretty nice neighborhoods. I mean, by the way, I should mention to our listeners that we have three types of properties. We have kind of the tier 1, the tier 2, or the tier 3, or the ABC. You can call them whatever you want. The top tier is like these brand new homes or very new homes. And that's one type of property. Then the B tier is, maybe it was built in 1990, 1985, that type of thing. And then the C tier is the lower end of the spectrum. And remember, it always works this way, folks. When you go down lower, your cash flow numbers look better and your rent to value ratio is better. But you tend to, and this is not always, but it's a general stereotype rule, you tend to get, of course, a lower quality tenant at the lower end of the spectrum in the C class types of properties. And so in order to earn that better rent to value ratio, you're going to deal with some more problems. It's likely, okay? You're going to have maybe evictions, collection issues, things like that. But still, even with all of this stuff, I mean, just look at any of the performance, like Sarah mentioned, at jasonhartman.com/properties, projected returns with assumptions in there for repairs and vacancies and, at least some of these issues. They could be worse, of course. I always say if it only works out half as well as projected, well, hey, you're going to make 17% annually, 20% annually, 22% annually. And if it works out as well or better than expected, well, you're probably above 35, 40% annually in your overall return on investment. So it's tough to beat that.
And I'd just like to comment, you can make money on both types of properties or all three types of properties.
Oh, absolutely.
But, I would recommend for someone that's a little bit newer to investing, maybe to start with a tier 1 or a tier 2 property because, it takes a little bit of the risk out of it. And for your first property, you really want to gain the experience and go into investing with the right mindset. And sometimes new investors get really attracted by the high returns on the more risky type properties. And when one thing doesn't go as planned, they get a little nervous about it. And so I can't tell you how glad I am that when I started with something a little bit newer and it was more like a passive investment. And then when I got into my next deal a couple years later, a few things came up and it was no big deal because I had already been through the process.
Right.
So whatever your time horizon is, whether you're doing a property a year or you're doing 10 properties at once, everybody's at a different level. It's important you talk to us about what your risk tolerance is in all of this and what your experience is so we can help you, make good decisions.
Yeah, that's what we do. We'll help you evaluate your risk tolerance, your time horizon, your investment goals, and really help you build a nationwide portfolio that works so you're properly diversified and you're not over-diversified. One of the mistakes that I have freely many times admitted to that I've made, over-diversifying, but you should be diversified for sure. Just don't overdo it. There's some great tips there, and Sarah, thank you for sharing those. So Little Rock, Dallas, and Houston, and Memphis, you sort of group Dallas and Houston together, actually. They're not the same place, but...
they're not, but they're Texas, and we love Texas.
We do.
And it's tough to get good inventory in those markets.
Yeah.
So get it while you can.
every hedge fund and private equity group has gone into those markets, and it is tough to get good inventory there, no question about it. But so when we have it, take advantage of it. And join us for the Little Rock Tour if you haven't signed up already. It's only a few weeks away. I will look forward to seeing everybody there that has already registered. So Sarah, thanks for joining us. And let's get to our guest, Jeff Reeves. We'll be with him in just a moment. It's my pleasure to welcome Jeff Reeves to the show. He is editor at investorplace.com and author of the Frugal Investor's Guide to Finding Great Stocks. Jeff, welcome. How are you?
I'm doing great, Jason. How about you?
Good. Let me give our listeners a sense of geography. Where are you located?
We are right outside Washington, D.C. in the wonderful suburb of Rockville, Maryland.
Fantastic. Well, Washington, D.C., the new bailout capital of planet Earth. Or at least it was a few years ago, that's for sure. What's going on in the economy and with the different markets as well nowadays? You know, lots of people think Wall Street's overvalued. It sounds like you don't think it's too overvalued, at least. You're still kind of bullish a little bit. I think cautiously maybe, but you can speak for yourself on that. And the economy, QE's going to be tapering off. And what's that going to do to interest rates, real estate, everything?
The bottom line is the bigger picture for the economy is slowly getting better. It's certainly not great yet, but it's better than it was a year ago, and it's better than it was the year before that. And I think this kind of slow and steady pace of the recovery has been frustrating to many of us, but that's neither here nor there. That's where we're at. And I do think that between the kind of sluggish nature of the economy, which is moving in the right direction, and then central bank policies and just demographics generally, I really don't think there is any other place to be than stocks right now. I mean, again, that's why I'm not too concerned with valuations. I think that they are a little bit more expensive, I think, than some people like. Historically, they're not too far outside the norm. I think the S&P's forward PE right now is about 17. That's slightly above historic norms of like 15, 16-ish, but it's not overtly so. And I think the biggest reason that the price-to-earnings ratios have become so high is because people are willing to pay a premium for growth because, frankly, there really isn't a great place to park your cash otherwise, right? I mean, you're going to get a CD in 1% rate of return in that. Are you going to get bonds with a 2 or 3% rate of returns? Most Americans kind of want a little more than that. And so they've been gravitating either to dividend stocks if they're conservative or just outright equities, even international equities if they're slightly more aggressive traders. I don't think valuations are too far outside historical norms. And the bottom line is I don't really think there's any good alternative to U.S. stocks right now. So I'm not going to fight it. I'm just going to ride it.
So that's the TINA concept. There is no alternative, right? TINA.
Yeah.
The thing is, though, when you talk about those historical norms, Jeff, those are historical norms, and we're not too far outside of them in terms of that PE ratio. But aren't those based, in really better economies? I mean, we just are maybe, depending on who you talk to, coming out of the worst economy in 7 decades. This is not the roaring 80s. It's not the roaring 90s. It's not the dot-com era. Does that matter?
Now we're getting into the realm of kind of philosophy about historical data metric. I'm a big believer in the fact that if it hasn't really happened since, basically 1978, I don't really care too much about it. I mean, there's a lot of data from Wall Street back in the 1920s, but back then it was all coal and railroad stocks, and now we live in the age of cloud computing and 3D printers. It is a fair point to say that while there is historical precedent for a lot of this stuff, in many respects we are kind of living this for the first time. I think that's a fair argument, and it's worth keeping perspective on. The more that I dig down into it, it is a market of stocks, as the old cliche goes, and there are stocks out there like Amazon that have a crazy PE that skew it higher. A lot of IPOs that we've had from companies with literally no profit. I would say that there are corners of the market like that get me very kind of nervous, but again, I don't think that you can kind of paint everything with a broad brush and think that just because there are some pockets that are overvalued. I do believe that, and I do believe that in the wake of the Great Recession, we're still feeling a lot of pain in many industries. There's also problems in retail, right? Simply just because of e-commerce and the unprofitability of brick and mortar in the age of Amazon.com and buying everything on the internet. So there are these kind of secular trends out there, but not to use another platitude, that's why some people tend to call this a stock picker's market, is because you have to find the opportunities within that, find pockets where there are values, value, find pockets of opportunity, and kind of leave the rest behind. It's a little more challenging that way, but frankly, that's kind of the way the market always is. The 30% upside we saw for everything in 2013, that's kind of an aberration. I think this kind of choppy up and down, some sectors are good, some sectors are bad, is probably a more faithful representation of things, right? Because there's always some areas of the economy that are doing well and some that are not, whether it's good times or bad.
Some of the greatest companies in the world have been launched during very tough economic times. They solved a problem and they had to be more lean and innovative, and that's why they succeeded. We talked about the TINA concept, that there is no alternative concept. You mentioned bank CDs, you mentioned bonds, and I completely agree with you on bonds. I mean, look at PIMCO, wow. Bonds, I've just never liked bonds because inflation will just cream them. You know, there are other problems with default possibilities too, and I think we're going to see that with a lot of municipalities potentially in the future. But the one thing you didn't mention, though, is real estate. You didn't mention like income property. Certainly you can get good returns with income properties in markets that aren't overvalued. Just from cash flow returns, we're between 8 and 15, 16% annually just on cash flow, even if the property doesn't go up in value or goes down in value, as long as you maintain the income and expense ratio.
Well, I would say that now is a very good time if you're a qualified borrower, because rates are pretty low, especially if you're someone of a decent credit standing and you have enough capital up front to put a decent down payment on a rental property. I do with you on that. I do think, though, that I probably don't have to say this to you, but our real estate is all about location, and I think that there's a big problem right now where, in my mind, again, when we talk about like historical data in the stock market and whether or not the numbers matter or they don't, when we kind of speak broadly about values for homes in the U.S., I think it's kind of doing people in their local markets a disservice. Like where I am, right around Washington, D.C., like there really was no housing crash, right? There's just not enough land for all the people that live here and have wonderful jobs either with the government or with government contractors. Those jobs didn't really go away. I kind of call D.C. like summer camp. We're not a faithful representation of the rest of the U.S. economy. So this housing market here has actually been very, very strong. And I don't ever anticipate the housing market here not being strong. There's literally no land in Arlington for them to build houses on. That's a vastly different story than Des Moines, Iowa, or Las Vegas. So I think that's very important for people to look at is when you talk about housing trends broadly, I would encourage people to kind of look at data on the local level instead of looking at some of these broader trends. While I agree with you that I think there is potential there, I think it is all about the market that you're in.
Oh, I couldn't agree with you more, Jeff. There's an old saying in real estate that all real estate is local. And, you know, that is so true. In a country as large and diverse as the United States, there are really about 400 housing markets. It just drives me nuts. I want to throw things at the TV when I'm, see some talking head come on CNBC and talk about the housing market. Where is the U.S. housing market? Is it in LA or Phoenix or Dallas? I don't know.
If you ask Case Shiller, they only think there's 20, right?
It's unbelievable.
20 areas.
And I'll tell you, with Case Shiller, 14 of those markets I wouldn't touch because you can't get cash flow in them. Of the Case Shiller 20, there are only really about 6 of them that make any real sense. For it to be a frugal, as you call it in the title of your book, a frugal, prudent investor who's going to be careful and conservative and not speculate on appreciation. You're just investing for long-term cash flow. If appreciation comes, icing on the cake, take it.
The word speculation, I think you hit something on the head there that I think right now when we talk about whether it's stocks or real estate or anything that's out there right now on Wall Street, I think that a lot of people are kind of leery of the notion of speculating and getting fast and furious returns. It's a wonderful story if you can double your money overnight. That's actually not very typical, and it's frequently not a very safe way to invest.
Right.
So I would say that, again, back to the idea of stocks right now, some being overvalued, like GoPro, that camera company that makes those wonderful videos about surfers and people doing backflips over the Grand Canyon, that company is valued at extremely high premiums to earnings, and it's a very frothy company that just went public. That's a very different investment than a utility stock that you're going to hold for 20 years and collect the dividends for. So I think that's an important thing to remember is the notion of speculation in what your investing strategy is. There are opportunities out there right now for people who just want to get long-term value and get some income in the market. And I think you have to know yourself and you have to know what you're after. And I think that'll guide you rather than just worry about whether the market broadly is overvalued or risky right now.
Mm-hmm. What do you think about Apple?
I'm pretty bullish on Apple. This is one of those companies, too, where people like to speculate and day trade. I don't pretend to believe that Apple is going to be the second coming and take over the world in the next 10 years. I also don't think that it's going to fall off the face of the planet. Just kind of looking at the numbers, I'm encouraged by the fact that iPhone sales are still very strong. They're 50% of revenue for the entire company. They're growing briskly overseas in markets like Russia and China and Brazil. I do think they have risks to their iPad line, which has had some softness, but Mac sales have been pretty good, and they got the new partnership with IBM, which could help it get kind of iPads and iPhones into the enterprise setting a little bit more. And by the way, back to the idea of kind of a conservative investment strategy for income, Apple has tons of room for dividend growth. The dividend right now may not be all that impressive at around 2%, but it's got $150 billion in cash. It's only paying out about a quarter or a third of its profits as dividends right now, so it has plenty of room for increases. So I think if you're a long-term investor who's willing to hang around with Apple and get paid as they deliver capital back to you, again, as an income investing strategy, I think I like it even at this price. And again, while there are stocks out there like GoPro that are really extremely frothy, when you back out Apple's cash, it's got a forward PE of about 10, and with the cash included, it's only about 14, which is less than the market's average broadly. So I don't think it's overbought. I think that it's at worst fairly valued, and I think that people have a good opportunity right now to get in before some of these big efforts, whether it be the IBM thing or the Beats acquisition, really start to drive bottom line impact in the year ahead.
Now, are they going to keep paying dividends? They almost really had to be forced to the last time around.
The kind of cliche out there is that Steve Jobs was very much kind of like a wartime president for Apple. He was there when the company was in the middle of its death throes, and he had to turn it around, and he was blazing a new trail for consumer electronics. That's not kind of Tim Cook's bag. I mean, Steve Jobs is an innovator. Tim Cook is just a peacetime president. He's supposed to keep the trains running on time and keep everybody happy with potato in every pot. And if that means, increasing dividends 10% a year and just delivering some capital back to shareholders without getting dramatic 100% year-over-year earnings growth, you can't get that. Apple's a $500 billion company, right? Like, what, they're going to double in size in the next 9 months? It's just not realistic. I think that Apple has kind of transitioned to a place now where it has to do dividends and buybacks. It has to kind of be this slow and steady wins the race company just because it's already got the scale. It's already got the dominance that Steve Jobs aspired to. And that's a good thing. And I think investors should embrace that. It's a different company, and I think a lot of people have trouble kind of looking at it in the new light. But I think Apple as it is now is still a good investment. It's not Apple as it was 5-10 years ago, but it's still a good investment.
Do you follow by any chance Herbalife?
I'm not touching that thing, man.
Yeah.
I mean, this is literally like just a war on the schoolyard between two factions who have a lot of money to throw at this thing. That is speculation at its best. I don't know if we're ever going to know the truth, but if we do know the truth, it's certainly not going to be anytime soon. And investors are just riding the sentiment. They're riding the PR war between the two firms. I kind of find it hard to bet at all against Carl Icahn because, he's kind of savvy and knows what he's doing, and he's been winning this battle so far. But I just don't know what the truth is, and I don't know, what guns are on either side. It's a war, and people can make a lot of money, I guess, if they guess right on that. But for the typical investor, man, I would just sit this one out and let them have their high-profile battle.
Totally agree with you. I mean, I wouldn't touch it, but it's just really interesting. I mean, what a drama. That's just an amazing drama, what's going on there.
Yeah, I mean, that's the internet age, right? It's not enough to go make $1 billion anymore. You got to do it in a public way and embarrass your enemy on CNBC. That's the internet for you.
Oh, there you go. Jeff, give out your website and tell people where they can find your book, too.
The website's investorplace.com. We like to figure ourselves as an actionable website for individual investors, which means we just give you commentary, not a lot of news. We tell you actually what to do with your money, which I think a lot of people find refreshing as opposed to just a rote regurgitation of earnings reports and data. And you can find a link to me and all my articles there and also the book if you're interested in it. And we have plenty of other free reports and newsletters and stuff for you to sign up for at investorplace.com.
Jeff Reeves, thanks so much for joining us.
Great to be here.
I've never really thought of Jason as subversive, but I just found out that's what Wall Street considers him to be.
Really? Now, how is that possible at all?
Simple. Wall Street believes that real estate investors are dangerous to their schemes because the dirty truth about income property is that it actually works in real life.
I know. I mean, how many people do you know, not including insiders, who created wealth with stocks, bonds, and mutual funds? Those options are for people who only want to pretend they're getting ahead.
Stocks and other non-direct traded assets are a losing game for most people. The typical scenario is you make a little, you lose a little, and spin your wheels for decades.
That's because the corporate crooks running the stock and bond investing game will always see to it that they win. This means, unless you're one of them, you will not win.
And unluckily for Wall Street, Jason has a unique ability to make the everyday person understand investing the way it should be. He shows them a world where anything less than a 26% annual return is disappointing.
Yep, and that's why Jason offers a one-book set on creating wealth that comes with 20 digital download audios. He shows us how we can be excited about these scary times and exploit the incredible opportunities this present economy has afforded us.
We can pick local markets untouched by the economic downturn, exploit packaged commodities investing, and achieve exceptional returns safely and securely.
I like how he teaches you how to protect the equity in your home before it disappears and how to outsource your debt obligations to the government.
And this set of advanced strategies for wealth creation is being offered for only $197.
To get your Creating Wealth Encyclopedia Book 1, complete with over 20 hours of audio, go to jasonhartman.com/store.
If you want to be able to sit back and collect checks every month, just like a banker, Jason's Creating Wealth Encyclopedia series is for you. This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.